Now let me ask you a question. What if I told you that the biggest threat to your financial future isn't a stock market crash? It isn't inflation, and it isn't even how much money you make. It's the mistakes you make when you first start investing. Small mistakes that don't feel dangerous at the time, but over 10, 20, or 30 years, they can quietly cost you hundreds of thousands of dollars in lost growth. Hello, and welcome to the Simply Speaking About Money video channel, where in this episode, we take a look at common mistakes to avoid in your investing journey. Before we begin, I want to make you a promise. If you watch this video all the way until the end, I'm going to share a special bonus strategy and tool recommendation that can dramatically simplify your investing journey, especially if you're just getting started and don't want to make costly mistakes. Today, we're breaking down the most common beginning investing mistakes that cost people years of progress and exactly how to avoid them. Most people don't fail at investing because they're lazy or irresponsible. They fail because no one ever taught them the rules. Schools don't teach this, families rarely talk about it, and social media often makes it worse by pushing hype instead of fundamentals. So people jump in blind, excited, hopeful, and completely unprepared. And that's where these mistakes begin. Let's start with the one that costs more money than any other. This is the most expensive mistake of all. Waiting. Waiting until you make more money. Waiting until you feel confident. Waiting until the perfect time. Here's the truth. Investing doesn't reward perfection. It rewards time. Someone who invests a small amount consistently starting at 25 will almost always outperform someone who invests more but starts at 35. Why? Compound growth. Your money doesn't grow in a straight line. It grows exponentially. And the earlier you start, the more powerful that growth becomes. This is why we recommend beginner-friendly investing platforms that allow automatic investing even with small amounts. Some of the tools we link in the description let you start with just a few dollars and build consistency over time. Starting early matters more than starting big. Many beginners believe they can outsmart the market. They say things like, I'll invest when prices drop, I'll wait for the next crash, I'll buy at the bottom. But even professional investors can't consistently time the market. What actually works is consistency. Investing a fixed amount on a regular schedule, often called dollar-cost averaging, removes emotion from the process. You invest when prices are high. You invest when prices are low. And over time, the average works in your favor. Many modern investing tools automate this entire process, which is why we include them in our recommended resources. The real risk isn't investing at the wrong time, it's staying out of the market too long. This is a big one. People think investing comes before budgeting. It doesn't. If you don't know where your money is going, you won't stick with investing when life gets expensive, and life always gets expensive. A budget keeps you consistent, prevents panic selling, reduces reliance on credit cards, protects your investments. We strongly recommend using a budgeting tool that automatically tracks spending and shows exactly how much you can invest each month without stress. Investing without a budget is like driving without a map. Quick transparency note before we continue. Some of the tools and platforms mentioned in this video and linked in the description are affiliate links. That means we may earn a small commission if you choose to use them at no extra cost to you. We only recommend tools we believe are genuinely helpful for beginners, and these commissions help support this channel and the creation of future content. Now let's continue. This is where many beginners lose confidence and money. They see viral stock picks, screenshots of massive gains, once-in-a-lifetime opportunities. So they chase, they buy high, they panic when prices fall, they sell at a loss. Real investing isn't exciting, it's boring, it's disciplined, it's patient. That's why diversified portfolios and broad market strategies outperform hype over time. Many beginner investing platforms offer pre-built diversified portfolios, which remove emotional decision-making, a major advantage when you're just starting. Fees don't look dangerous until you see the long-term impact. A small percentage fee can quietly cost you tens of thousands of dollars over decades. The same goes for taxes. Beginners often don't understand expense ratios, trading fees, tax-advantaged accounts. Low-cost investing platforms and automated tools can help minimize these losses by design. The less money lost to fees and taxes, the more money compounds for you. This mistake destroys investing plans. Without an emergency fund, your investments become your backup plan, and that forces you to sell at the worst possible time. Before aggressively investing, you should have 3 to 6 months of essential expenses saved, creating easy access to cash when you need it. No need to rely on credit cards in emergencies. High-yield savings tools, which we also recommend, allow your emergency fund to earn interest while staying safe. Investing works best when you don't need the money right away. If you're serious about avoiding these mistakes, take a moment to check the links in the description. We've included investing, saving, and budgeting tools that we recommend in our program, especially for beginners who want automation, simplicity, and long-term growth. Many of them offer free trials or beginner bonuses. This mistake costs people their future wealth. Beginners often quit after a market dip, a slow year, a scary headline. But volatility isn't failure, it's normal. The market has survived recessions, crashes, and global crises, and continued to grow over time. The people who succeed aren't smarter, they're more patient. Automation helps remove emotion, which is why many long-term investors rely on it. Investing without a goal leads to confusion and bad decisions. Are you investing for retirement, a home, financial freedom, long-term security? This belief keeps people stuck. You don't need thousands of dollars. You don't need perfect knowledge. You don't need to be an expert. Clarity creates confidence. You need consistency and patience. The right tools. Fractional investing and automated platforms have eliminated most barriers. The real obstacle isn't money, it's mindset. As promised, here's your bonus. The single most effective way to avoid most beginner investing mistakes is to combine 3 tools: a budgeting tool to control cash flow, a high-yield savings account for emergencies, an automated investing platform for long-term growth. When these work together, investing becomes simple, consistent, and stress-free. We've linked our recommended versions of all 3 in the description so you can explore them in one place. If you feel like your money disappears before the month is over, it's not a math problem, it's a plan problem. That's where YNAB, you need a budget, comes in. YNAB is built on one simple principle: give every dollar a job before you spend it. Instead of guessing where your money went, you decide where it goes, in advance. It helps you break the paycheck-to-paycheck cycle, build real savings, and finally feel in control of your finances. This isn't about restriction, it's about intention. If you're serious about budgeting the right way, check out the link in the description to try YNAB for yourself. Affiliate disclosure. I may earn a commission if you sign up using my link at no extra cost to you. Let's finish things up. A strong financial plan starts with where you keep your cash. That's where Capital One 360 Performance Savings comes in. This high-yield savings account is designed to help your emergency fund, and short-term savings grow faster than traditional brick-and-mortar banks. No complicated investing, no market risk, just competitive interest on the money you're already saving. It's simple, secure, and built for smart cash management. If you're ready to upgrade your saving strategy, check out the link in the description to explore Capital One 360 Performance Savings. I may earn a commission if you sign up using my link, at no extra cost to you. Budgeting is step 1. Investing is step 2. That's where Acorns comes in. Acorns helps you start investing automatically, even with your spare change. It rounds up your everyday purchases and invests the difference into diversified portfolios built for long-term growth. You don't need thousands of dollars. You don't need to be an expert. You just need to start. When you pair smart budgeting with automatic investing, you build momentum, and momentum builds wealth. If you're ready to make your money work while you sleep, check out the link in the description to get started with Acorns Affiliate Disclosure. I may earn a commission if you sign up using my link at no extra cost to you. If this video helped you, don't overthink the next step. Choose one tool from the description, commit to using it for the next 90 days. Your future self will thank you, because the biggest investing mistake isn't losing money. It's never giving your money the chance to grow.